Hello, and welcome to the Bureau of Consumer Financial Protection's webinar on Regulation C and the amendments made by the Bureau in 2015 and 2017. This webinar was first delivered in the summer of 2016 and was the first in a series of HMDA-related webinars that the Bureau presented to help institutions understand and comply with the rule. We have updated it to reflect the Regulation C amendments issued by the Bureau in 2017. The amendments to HMDA made by the Economic Growth, Regulatory Relief, and Consumer Protection Act in May 2018, which we will refer to as the Act, and the HMDA Interpretive and Procedural Rule issued by the Bureau in 2018, which we will refer to as the 2018 Rule. In today's webinar, we will provide an overview of Regulation C with a specific focus on institutional coverage, transactional coverage, data disclosure and the submission process, and some key dates. We will also review the amendments to HMDA made by the Act and the 2018 Rule, as well as the data disclosure policy guidance issued by the Bureau in 2018. Before we begin, we need to let you know that the Bureau releases webinars, like this one, to help institutions comply with the Bureau's rules. This webinar provides a summary of certain requirements in HMDA and Regulation C and practical examples of those requirements. The examples provided in this webinar do not illustrate all possible situations that could trigger a particular obligation or satisfy a particular requirement. You can use an alternative approach if the approach satisfies the requirements of HMDA and Regulation C. This webinar is not a legal substitute for HMDA or Regulation C and its official interpretations. The content of this webinar is current as of August 2019. Now let's begin. Let's start with some background information on HMDA and Regulation C. HMDA was enacted by Congress in 1975. And implemented by the Federal Reserve Board's Regulation C in 1976. HMDA's purposes are to collect information about home mortgages in order to help determine whether financial institutions are serving the housing needs of their communities. Assist public officials in distributing public sector investment to attract private investment to areas where it is needed. And assist with the identification of possible discriminatory lending patterns and enforcement of anti-discrimination laws. So who uses HMDA data? Public officials use the data to develop and allocate housing and community development investments, respond to market failures, and monitor whether financial institutions may be engaging in discriminatory lending practices. Communities use the data to ensure that lenders are serving the needs of individual neighborhoods. Participants in the mortgage industry use the data to inform them of business practices. HMDA and Regulation C have been updated and expanded over time in response to the changing needs of homeowners and the evolution of the mortgage market. In 2010, Congress enacted the Dodd-Frank Wall Street Reform and Consumer Protection Act, also known as the Dodd-Frank Act. The Dodd-Frank Act amended HMDA by transferring rulemaking authority from the Federal Reserve Board to the Bureau and adding new reporting requirements. The Bureau issued a proposal to amend Regulation C on July 24, 2014 to implement the Dodd-Frank Act amendments, require the collection, recording, and reporting of additional information to further HMDA's purposes, and modernize the manner in which institutions report HMDA data. The Bureau received approximately 400 comments and carefully reviewed and considered those comments. The Bureau issued a final rule on October 15, 2015. The final rule changes the type of financial institutions subject to Regulation C, the types of transactions subject to Regulation C, the data that financial institutions are required to collect, record, and report, and the processes for reporting and disclosing the data. In addition, the Bureau issued proposals in April and July 2017 to clarify and make changes to certain requirements and make technical corrections. The Bureau issued a final rule based on these proposals on August 24, 2017. Today we will cover the types of financial institutions and types of transactions subject to Regulation C. We will also review information regarding changes to the data submission process and disclosures, as well as go over the dates that various parts of the HMDA rule became effective. Let's begin with institutional coverage. An institution is required to comply with the rule only if it is a financial institution as defined by Regulation C in Section 1003.2. The scope of institutional coverage under Regulation C took effect in two phases. The first phase was effective on January 1, 2017. The first phase narrowed the scope of depository institutions subject to Regulation C. A depository institution is a bank, savings association, or credit union. Under this first phase, a depository institution was not required to collect, record, and report HMDA data unless it met the asset size test, location test, loan activity test, federally related test, and it originated at least 25 home purchase loans, including refinancings of home purchase loans in both 2015 and 2016. The only change for 2017 was the addition of the threshold of at least 25 home purchase loans. The second phase changed the scope of institutional coverage and became effective beginning on January 1, 2018. The second phase adopts the same loan volume threshold test for both depository institutions and non-depository institutions. Note that Regulation C continues to have separate coverage tests for depository institutions and non-depository institutions. An institution, whether it is a depository or non-depository, will be required to comply with Regulation C if it originated at least 25 closed-end mortgage loans in each of the two preceding calendar years, or it originated at least 500 open-end lines of credit in each of the two preceding calendar years, provided that it met the remaining coverage criteria for either depository institutions or non-depository institutions. Later in this webinar, we will walk through the definition of closed-end mortgage loan and open-end line of credit, which are defined terms that became effective on January 1, 2018. Let's walk through the 2018 institutional coverage chart available on the Bureau's HMDA implementation webpage. First, let's look at the coverage criteria for non-depository institutions. The first test is to determine whether the institution is a for-profit mortgage lending institution that is not a bank, savings association, or credit union. If the institution meets this criterion, then the institution would check to see if it satisfies the location test for non-depository institutions. First, the institution would look at its locations and determine whether it had a home or branch office in a metropolitan statistical area, known as an MSA, on December 31st of the preceding year. If not, the institution would look to see if it received applications for, originated, or purchased 5 or more covered loans related to property located in the same MSA or metropolitan division, known as an MD, in the preceding calendar year. If the non-depository institution meets either of these two criteria, then we move on to the loan volume test, which is whether the institution originated at least 25 closed-end mortgage loans in each of the two preceding calendar years, or at least 500 open-end lines of credit in each of the two preceding calendar years. The emphasis on the loan volume test is on or. The institution would meet the loan volume test if it originated at least 25 closed-end loans in each of the two preceding calendar years, but did not originate at least 500 open-end lines of credit in each of the two preceding calendar years. In this case, however, the institution would be required to report information only about its closed-end lending. Conversely, an institution that originated at least 500 open-end lines of credit in each of the two preceding calendar years, but did not originate at least 25 closed-end loans in each of the two preceding calendar years, would be required to report information only about its open-end lending. An institution is only covered if it satisfies the threshold for 2 consecutive years. We call this the 2-year look-back period. The 2-year look-back period is intended to eliminate uncertainty around reporting responsibilities for institutions that may have an unexpected increase in origination loan volume in 1 year but not in the next. The Bureau hopes this will relieve some institutions of significant one-time costs, including staff training and information technology changes related to first-time HMDA reporting. To summarize, if the non-depository institution met the tests that we discussed, then it will be required to collect HMDA data. This means that it would collect data under Regulation C for the calendar year and submit that data by March 1st of the following year. Next, let's look at the coverage test for depository institutions. The change beginning in 2018 was whether the institution originated at least 25 closed-end mortgage loans in each of the 2 preceding calendar years, or at least 500 open-end lines of credit in each of the 2 preceding calendar years. The asset size test, location test, loan activity test, and federally related test remain the same. Similar to non-depository institutions, a depository institution would only need to originate at least 25 closed-end loans in each of the 2 preceding calendar years, or at least 500 open-end lines of credit in each of the 2 preceding calendar years to meet this requirement. Now let's move on to transactional coverage. The types of transactions that are covered under Regulation C were modified, changing from a purpose-based test to a dwelling-secured test for consumer purpose transactions. Commercial purpose transactions will need to meet both the dwelling-secured test and the purpose-based test to be covered. Transactions covered by Regulation C are called covered loans. A covered loan can either be a closed-end mortgage loan or open-end line of credit. Whether the transaction involves a closed-end mortgage loan or an open line of credit, it must be secured by a dwelling to be covered. Section 1003.2d defines a closed-end mortgage loan as an extension of credit that is secured by a lien on a dwelling and that is not an open-end line of credit. Section 1003.2o defines an open-end line of credit as an extension of credit that is secured by a lien on a dwelling and is an open-end credit plan as defined under Regulation Z, Section 1026.2a20, without regard to whether the credit is consumer credit, extended by a creditor, or extended to a consumer. Note that the definitions for closed-end mortgage loan and open-end line of credit apply to the loan volume thresholds we discussed earlier. An extension of credit refers to a new debt obligation. In general, if the transaction modifies, renews, extends, or amends the debt obligation but does not satisfy and replace it, the transaction would not be considered an extension of credit under Regulation C. Note that the term extension of credit has a different meaning under Regulation B, which interprets the Equal Credit Opportunity Act. Under Regulation B, Section 1002.2q, extension of credit means the granting of credit in any form, including the renewal of credit and the continuance of existing credit in some circumstances. Under Regulation C, the term extension of credit generally refers to the granting of credit pursuant to a new debt obligation. However, there are 2 types of transactions that are considered extensions of credit under Regulation C, even though they may not involve new debt obligations. One type of transaction is an assumption. Some assumptions have historically been covered under Regulation C. For purposes of Regulation C, an assumption is a transaction in which the financial institution enters into a written agreement accepting a new borrower as the obligor on an existing obligation. In such a situation, no new debt obligation is created, but rather the new borrower assumes an existing debt obligation. Under Regulation C, assumptions include successor and interest transactions, which are transactions in which an individual succeeds the prior owner as the property owner and then takes on the existing debt secured by the property. The other type of transaction that does not necessarily involve a new debt obligation but is reported is a transaction pursuant to a New York State Consolidation, Extension, and Modification Agreement, also known as a CEMA, and classified as a supplemental mortgage under New York Tax Law Section 255, such that the borrower owed reduced or no mortgage recording taxes. New York CEMAs are loans secured by dwellings located in New York State and often may be used in place of traditional refinancings, either to amend the interest rate or loan term or permit the borrower to take cash out. Covered financial institutions generally will not be required to report any preliminary transaction where a consumer receives additional funds prior to consolidation into a New York CEMA transaction. However, financial institutions will be required to report the New York CEMA transaction. The second test for both a closed-end mortgage loan and an open-end line of credit is whether the transaction was secured by a lien on a dwelling. A dwelling is a residential structure whether or not the structure is attached to real property. A dwelling is not limited to a principal residence, nor is it limited to a structure that has 4 or less units. Here are some examples of dwellings: second homes and vacation homes, investment properties, manufactured homes, or other factory-built homes. A transaction related to a manufactured home community is secured by a dwelling under Regulation C, even if it is not secured by individual manufactured homes, but only by the land that constitutes that manufactured home community, including sites for manufactured homes. Multifamily residential structures or communities, such as apartments, condominiums, and cooperative buildings or complexes, or manufactured homes. Certain structures or properties are not considered dwellings under Regulation C. Here are some examples. Recreational vehicles, for example, boats, campers, travel trailers, and park model recreational vehicles. Houseboats, floating homes, and mobile homes constructed before June 15, 1976 are not considered dwellings, even if they are used as residences. Transitory residences are also not considered dwellings. Examples of transitory residences include hotels, hospitals, and college dorms. Lastly, structures that were originally designed as a dwelling but converted to exclusive commercial use, for example, a home converted to a professional office, are not considered dwellings. Certain properties may be used for both a residential and commercial purpose. An example would be a building that has both apartment units and retail space. A financial institution would need to determine, using any reasonable standard, the primary use of the property, such as square footage or income generated, and may select the standard on a case-by-case basis. If the property's primary use is residential, then it would be considered a dwelling. Let's recap. A closed-end mortgage loan is an extension of credit secured by a lien on a dwelling, and that it is not an open-end line of credit. What is an open-end line of credit? Section 1003.20 provides that an open-end line of credit is an extension of credit secured by a dwelling, and that is an open-end credit plan under Regulation Z, Section 1026.2A20, but without regard to whether the credit is consumer credit, extended by a creditor, or extended to a consumer. An open-end credit plan is one in which the creditor reasonably contemplates repeated transactions. The creditor may impose a finance charge from time to time on an outstanding unpaid balance. And the amount of credit that may be extended to the borrower during the term of the plan up to the limit established by the creditor is generally made available to the extent that any outstanding balance is repaid. There are 12 types of transactions that are specifically excluded from Regulation C. These are provided in Section 1003.3C in Regulation C. We will review several of these types of transactions. First, a closed-end mortgage loan or open-end line of credit that is secured by a lien on unimproved land. A loan or line of credit is secured by a lien on unimproved land if the loan or line of credit is secured by vacant or unimproved property. However, the exclusion will not apply if the institution knows, based on information that it receives from the applicant or borrower at the time of the application is received or the credit decision is made, that the proceeds of the loan or credit line will be used within 2 years after closing or account opening to construct a dwelling on or to purchase a dwelling to be placed on the land. For example, if the applicant tells the financial institution that funds from the loan will be used to construct a dwelling on the land within 2 years after closing, then the transaction is reportable in the financial institution's HMDA data if it is otherwise reportable. Note that if the transaction meets another exclusion, such as the temporary financing exclusion under Section 1003.3 C3, then the transaction is not reportable. Second, a closed-end mortgage loan or open-end line of credit that is temporary financing. Temporary financing is not determined by the duration of the loan, but rather, in general, whether the transaction is designed to be replaced by separate permanent financing extended by any financial institution to the same borrower at a later time. An example of a transaction obtained for temporary financing is a construction loan where the proceeds will be used to finance the construction phase of the dwelling and where a new extension of credit will later be obtained for permanent financing. Here, the loan to fund the construction phase would be excluded as a temporary financing. A construction-only loan or line of credit is also considered temporary financing if the loan or line of credit is extended to a person exclusively to construct a dwelling for sale. On the other hand, if the transaction is a construction to permanent loan where the proceeds will be used to finance the construction of a dwelling, but the loan will automatically be converted to permanent financing without a separate closing once construction is complete, the transaction is not excluded as temporary financing. Third, a closed-end mortgage loan or open-end line of credit that is used primarily for agricultural purposes. A loan or line of credit is used primarily for agricultural purposes if the proceeds will be primarily for agricultural purposes, or if the loan or line of credit is secured by a dwelling located on real property that is used primarily for an agricultural purpose, such as a farm. The institution may use any reasonable standard to determine the primary use of the property and may select any reasonable standard to apply on a case-by-case basis. What is meant by agricultural purpose? Regulation C looks to Regulation Z's commentary. The fourth type of excluded transaction we will review today is a closed-end mortgage loan or open-end line of credit that is or will be made primarily for a business or commercial purpose. However, if the financial institution determines that the proceeds of a closed-end mortgage loan or open-end line of credit will primarily be used for a commercial or business purpose, but that it also meets the Regulation C definition of a home improvement loan, home purchase loan, or a refinancing, then the transaction would be a covered loan unless another exclusion applies. An example of a commercial or business purpose transaction that is covered under Regulation C, unless another exclusion applies, is a closed-end mortgage loan to purchase a multifamily dwelling secured by the dwelling. Another example of a commercial or business purpose transaction that is covered under Regulation C, unless another exclusion applies, is a closed-end mortgage loan or open-end line of credit to improve an office that is located in a dwelling other than a multifamily dwelling. The loan proceeds will be used primarily for business or commercial purposes, but the loan is a home improvement loan under Regulation C. An example of a transaction with a business or commercial primary purpose that is not covered under Regulation C is a closed-end mortgage loan or open-end line of credit where the proceeds will be used primarily to expand a business that is not located in a dwelling or is located in a multifamily dwelling. Another example is where the proceeds of the closed-end mortgage loan or open-end line of credit will be used primarily to purchase business equipment. In both cases, the loan or line of credit does not also meet the definition of home improvement, home purchase loan, or a refinancing. Such transactions would be excluded even if the transactions were cross-collateralized by a covered loan. The final topic to point out in the category of excluded transactions is that a financial institution may not have to report data on all of its covered loans. Regulation C includes transactional thresholds that exclude either closed-end mortgage loans or open-end lines of credit, depending on whether it originated fewer than 25 closed-end mortgage loans or 500 open-end lines of credit in either of the 2 preceding calendar years. As mentioned earlier, a financial institution will not be required to collect, record, and report closed-end mortgage loans if it originated fewer than 25 of them in either of the 2 preceding calendar years. Similarly, a financial institution will not be required to collect, record, and report open-end lines of credit if it originated fewer than 500 of them in either of the 2 preceding calendar years. Some institutions may meet the threshold for reporting closed-end mortgage loans, but not open-end lines of credit, and therefore would be required to collect and report data on closed-end mortgage loans only. On the other hand, some institutions may meet the threshold for open-end lines of credit, but not closed-end mortgage loans, and therefore would be required to collect and report data on open-end lines of credit only. A financial institution has the option of reporting loans that are otherwise excluded from reporting requirements because the financial institution did not satisfy the loan volume thresholds. However, if a financial institution chooses to report the excluded transactions, it is obligated to report all such applications, originations, and purchases for that calendar year. Let's review the following table and discuss scenarios where an institution would or would not be obligated to report closed-end mortgage loans or open-end lines of credit. In the table with the loan volume thresholds examples, Institution A originated 30 closed-end mortgage loans in 2016 and 24 in 2017. For open-end lines of credit, Institution A originated 1,000 in 2016 and 1,200 in 2017. In this scenario, Institution A will be required to collect data on open-end lines of credit in 2018 for submission in 2019 because the number of open-end lines of credit it originated in both 2016 and 2017 exceeded the threshold of at least 500. Institution A will not be required to collect data on its closed-end mortgage loans because it did not originate at least 25 closed-end mortgage loans in both 2016 and 2017. Let's take a look at Institution B's lending activity. In 2016, Institution B originated 30 closed-end mortgage loans and 499 open-end lines of credit. In 2017, Institution B originated 45 closed-end mortgage loans and 505 open-end lines of credit. For 2018 data collection for submission in 2019, Institution B will only be required to collect data on its closed-end mortgage loans because for both 2016 and 2017, it originated at least 25 closed-end mortgage loans. It will not be required to collect data on its open-end lines of credit because it originated only 499 open-end lines of credit in 2016. Let's move on to Institution C's origination volumes. In 2016, Institution C originated 55 closed-end mortgage loans and 150 in 2017. For its open-end lines of credit, it originated 550 in 2016 and 600 in 2017. Here, Institution C will be required to collect data on its 2018 closed-end mortgage loans and open-end lines of credit because, unlike Institutions A and B, Institution C's origination volumes for closed-end and open-end met or exceeded the loan volume thresholds for both 2016 and 2017. Now let's look at an example of an institution that would not be required to collect and report data because its loan volume activity did not meet or exceed the threshold in one or both years. Institution D originated 22 closed-end mortgage loans in 2016 and in 2017. It originated 26 closed-end loans. In 2016, Institution D originated 498 open-end lines of credit, and in 2017, it originated 430 open-end lines of credit. Institution D will not be required to collect HMDA data for 2018 because it did not meet the loan volume test. The next few slides make up a chart that will walk you through one way of analyzing whether a transaction is covered under Regulation C. This chart is available on the Bureau's HMDA Implementation webpage. This first page of the chart contains an overview of some of the suggested key questions to consider when determining whether the transaction involves a covered loan. The first step is to determine whether the transaction is excluded based on its purpose. Remember that a transaction that is primarily for agricultural purposes is excluded, even if it is secured by a dwelling. A transaction that is primarily for a business or commercial purpose could possibly be excluded. It would depend on whether the transaction is also a home improvement loan, home purchase loan, or a refinancing. If the transaction is not excluded based on its purpose, then the next question is to determine whether the transaction is secured by a lien on a dwelling. This page of the chart provides examples of what is and what is not a dwelling. Next, determine if the transaction involves an extension of credit. To answer this question, ask whether the transaction is pursuant to a new debt obligation. If not, it generally will not be an extension of credit and will not be a covered transaction. However, you will need to confirm whether the transaction is an assumption or a New York State CEMA. Under Regulation C, these types of transactions are extensions of credit, even if there is no new debt obligation. The final step in the analysis is to determine whether the transaction is excluded for other reasons. This last page of the chart illustrates how meeting the loan volume threshold for closed-end loans or open-end lines of credit will require the institution to collect and report all of the applicable transactions in the category of loan volume thresholds that the institution meets. However, an institution will not be required to report data on closed-end loans or open-end lines of credit if it did not originate the minimum threshold in either of the 2 preceding calendar years. Covered consumer and business or commercial purpose originations should be counted together when determining whether the institution met the threshold minimum. As mentioned earlier in this webinar, if the institution originated the minimum number of closed-end mortgage loans but not open-end lines of credit, then it would need to report only the covered closed-end mortgage loans, including applications that did not result in an origination. It will not need to report data on open-end lines of credit. Let's discuss when an institution reports a covered transaction. Once a financial institution has determined that the transaction is covered, it must determine whether it has engaged in activity that obligates it to report information about the transaction. A financial institution collects and reports information for actions taken on applications for covered loans, originations of covered loans, and purchases of covered loans. If the application did not result in an originated covered loan, a financial institution collects and reports the application if the financial institution took action on the application or even if the application was withdrawn while the financial institution was reviewing it. If a financial institution receives an application and then the application results in an origination, the financial institution would report only the origination of the covered loan rather than reporting separately the application and the origination. So what is an application? An application is an oral or written request for a covered loan that is made in accordance with the procedures the financial institution uses for the type of credit requested. A request for a pre-approval is considered an application under Regulation C if the request is for a home purchase loan that is not secured by a multifamily dwelling that is not for an open-end line of credit or reverse mortgage, and that is reviewed under a pre-approval program. A pre-approval program is one in which the financial institution conducts a comprehensive analysis of the applicant's creditworthiness, resources, and other matters typically reviewed as part of the financial institution's credit evaluation program, and then issues a written commitment that is for a home purchase loan valid for a designated period of time up to a specified amount and subject to only specifically permitted conditions. The permitted conditions are conditions that require the identification of a suitable property, conditions that require no material change occur regarding the applicant's financial condition or creditworthiness prior to closing, and limited conditions that are not related to the applicant's financial condition or creditworthiness and the financial institutions ordinarily attaches to a traditional home mortgage application. For example, the requirement of an acceptable title insurance binder or a certificate indicating a clear termite inspection. A financial institution is required to report data on pre-approval requests only if the pre-approval request is denied, results in the origination of a home purchase loan, or was approved but not accepted. Let's move on to who reports the transaction when there are multiple entities involved. Only one financial institution reports each originated covered loan as an origination. The financial institution that made the credit decision approving the application before closing or account opening reports the loan as an origination regardless of whether the loan closed in the institution's name. This is also how an institution determines whether it has originated a particular loan for the purposes of institutional coverage criteria and transactional thresholds that we discussed a moment ago. Let's walk through one example. Elm Bank received an application for a covered loan from an applicant and forwarded that application to Oak Bank. Oak Bank reviewed the application and approved the loan prior to closing. The loan closed in Elm Bank's name. Oak Bank purchased the loan from Elm Bank after closing. Oak Bank was not acting as Elm Bank's agent. Since Oak Bank made the credit decision prior to closing, Oak Bank reports the transaction as an origination, not as a purchase, and reports all of the data fields required for originated loans. Elm Bank does not report the transaction. Oak Bank also counts this loan as an origination for purposes of the institutional coverage and transactional coverage tests. What happens when more than one institution approved an application prior to closing or account opening, and one of those institutions purchased the loan after closing? In this case, the institution that approved the application before closing and purchased the loan after closing reports the loan as an origination. A financial institution reports the action it took on all applications that it receives. It does not matter whether the financial institution received the application from the applicant or from a broker or another financial institution. It also does not matter if the application for a covered transaction does not result in an origination. If an institution made the credit decision through the actions of an agent as defined by state law, the institution reports the application or origination. For example, Ficus Bank, acting as Elm Bank's agent, receives an application for a closed-end mortgage loan and makes a credit decision approving the loan. The applicant does not, however, accept the loan. Who reports the transaction? Here, Elm Bank would report the action taken by its agent, Ficus Bank, and would report the application as approved but not accepted. Ficus Bank would not report the application because it was acting as an agent of Elm Bank. Institutions may have a variety of relationships with other institutions, and such relationships may play a role in determining which institution reports in a given situation. We encourage you to review comments 4A-2 through 4, which address additional scenarios. This includes how to report if an institution makes a credit decision using another entity's underwriting criteria, and how this plays out when more than one institution is involved. Moving on to the data submission process. Beginning with data collected in 2017 and submitted by March 1, 2018, financial institutions must submit their HMDA data electronically. Financial institutions must submit their data to the appropriate federal agency by March 1st, following the calendar year for which it collected the data. The Bureau developed a web-based tool for electronically submitting HMDA data. Additional information regarding this tool and other information on HMDA submission procedures can be found on the Federal Financial Institution Examination Council's, known as the FFIEC, HMDA webpage at ffiec.cfpb.gov. Effective on January 1, 2020, larger volume reporters, those financial institutions that reported at least 60,000 combined covered loans and applications, excluding purchase covered loans, for the preceding calendar year will be required to report data on a quarterly basis. These financial institutions must report all data required to be recorded for the calendar quarter within 60 calendar days after the end of the calendar quarter. If a financial institution makes a good faith effort to fully and accurately report its quarterly data, and some data are nevertheless inaccurate or incomplete, those deficiencies do not violate HMDA or Regulation C, provided that the institution corrects or completes the data prior to submitting its annual loan application register. Quarterly reporting will not apply to a financial institution's fourth quarter data. Instead, the financial institution reports its fourth quarter data as part of its annual submission. The financial institution's annual submission must contain the data for the first 3 calendar quarters, including any corrections, plus its fourth quarter data. For example, if Ficus Bank reported 60,000 covered loans and applications in its 2019 HMDA data, it will meet the requirements to be a quarterly reporter and will be required to report its January 1st through March 31st, 2020 HMDA activity by May 30th, 2020. Its second quarter data will be due by August 30th, 2020, and its third quarter data will be due by November 30th, 2020. Ficus Bank will then submit its fourth quarter data along with the previously submitted first, second, and third quarter data, including corrections, by March 1st, 2021. Financial institutions that do not report at least 60,000 covered loans and applications in the preceding calendar year are not required to submit quarterly HMDA data. For example, if Pine Bank reported 59,999 covered loans and applications in 2019, then it will not be required to report its 2020 data on a quarterly basis. Let's move on to the disclosure of data. Beginning in 2018, with respect to data collected in 2017 and later years, the FFIEC shall provide notice to the financial institution that its disclosure statement, based on data submitted for the prior calendar year, is available. The financial institution must make available to the public no later than 3 days after receiving notice from the FFIEC a written notice that clearly conveys that the financial institution's disclosure statement may be obtained from the Bureau's HMDA webpage at www.consumerfinance.gov/HMDA. The notice may be available in paper or electronic form. Here is a sample notice. The suggested language for the notice can be found in comment 5B-3. The financial institution must make the notice available to the public for a period of 5 years. A financial institution may also provide its disclosure statement to a requester and charge a reasonable fee for costs incurred in reproducing or providing the statement. If a financial institution opts to provide its disclosure statement to a requester, it must still comply with the notice requirement. Beginning in 2018, with respect to data collected in 2017 and later years, upon request from a member of the public, a financial institution must provide a written notice regarding the availability of the modified loan application register. The notice must clearly convey that the financial institution's loan application register, as modified by the Bureau to protect applicant and borrower privacy, may be obtained on the Bureau's HMDA webpage at www.consumerfinance.gov/HMDA. A financial institution may use this sample notice. The suggested language for the notice can be found in comment 5C-2. The financial institution must make the notice available to the public for a period of 3 years. A financial institution may also provide its modified loan application register to a requester and charge a reasonable fee for costs incurred in reproducing or providing the modified loan application register. If a financial institution opts to provide its modified loan application register to a requester, it must still comply with the notice requirement. Let's move on to the overview of the effective dates for the various provisions, Regulation C, under the October 2015 rule. Here is the key dates timeline available on the Bureau's HMDA implementation webpage. This timeline summarizes the effective dates for various provisions, and it also illustrates when data collection would begin and when the data collected must be submitted, because those two activities generally occur in 2 different calendar years. Let's review the dates to be reported for the final action taken on an application. The date of final action is based on the final disposition of the application. This page summarizes the dates to be reported. For example, for a loan that was originated, the date of final action to be reported is generally the date the loan closed, or in the case of an open-end line of credit, the date the account was opened. Regulation C provides some flexibility regarding the date of final action to be reported on originations. For example, comment 4A8 Romanet 2-5 explains that for a construction to permanent loan, the institution can report either the date of the loan closing or account opening, or the date of the loan converted to permanent financing. Even with the flexibility Regulation C provides, the institution must still report the origination as occurring in the year in which the origination goes to closing or the account is opened. For applications approved but not accepted, an institution may choose any reasonable date, including the approval date, the deadline that was established for accepting the offer, or the date the file was closed. Although the institution does not need to use the same approach for its entire submission, the institution should be consistent, such as using the same approach for a category of loans. For files closed for incompleteness, the institution may report the date the file was closed or the date the notice was sent to the applicant. Note, however, that a pre-approval request that was withdrawn or closed for incompleteness is not HMDA reportable. As we discussed, the effective date is tied to the date on which final action is taken on the application. This may be weeks or months after the application date. The chart on this page provides examples of applications received in both 2017 and 2018 and where final action is taken in 2017 and 2018. The chart further illustrates what should be collected and by when it must be reported. For example, an application that is received on October 1, 2017 with a loan origination date of December 1, 2017 was reportable with the institution's 2017 HMDA data that was to be submitted by March 1, 2018. The data to be collected would have been in accordance with Regulation C in effect in 2017. This means that for this loan, the institution would not have collected the new data points under the 2015 rule. On the other hand, an application that is received on October 1, 2017 with a loan origination date of January 5, 2018 is reportable with the institution's 2018 HMDA data to be submitted by March 1, 2019. A financial institution reports the covered loans it purchased based on the date of purchase. For example, if the financial institution purchased a covered loan on October 1, 2017, then it should have reported that purchase with its 2017 HMDA data that was to be submitted by March 1, 2018. On the other hand, if the financial institution purchased a covered loan on January 5, 2018, then it would report the purchase in accordance with the 2015 rule with its 2018 HMDA data to be submitted by March 1, 2019. As a reminder, the 2015 and 2017 rules modify certain data points and add others, including data points for age, credit score, automated underwriting information, debt-to-income ratio, unique loan identifier, property value, application channel, points and fees, and loan term. These data points are discussed in subsequent webinars. One exception to the general rule that the effective date is tied to the final action date is the collection of information about ethnicity, race, and sex. The effective date for collection of the new race and ethnicity categories is tied to application date. For an application that was received February 15, 2018, and where final action was taken on March 15, 2018, the financial institution must collect and report the data in accordance with Regulation C in effect for 2018 and must also collect the race, ethnicity, and sex information in accordance with the Appendix B instructions in effect in 2018. Another change that became effective on January 1, 2018 is that financial institutions were required to submit their data electronically using the web-based tool developed by the Bureau. This means that beginning with the data the financial institutions collected in 2017, the financial institution must have submitted data electronically. Also effective in 2018 is the requirement to provide to the public upon request notices that the institution's disclosure statement and modified loan application register are available on the Bureau's website. On January 1st, 2019, changes to the enforcement provisions became effective. The enforcement provisions provide that when the quarterly reporting requirements become effective, inaccuracies or omissions in quarterly reporting are not violations of HMDA or Regulation C if the financial institution makes a good faith effort to report quarterly data timely, fully, and accurately, and then corrects or completes the data prior to its annual submission. As noted, beginning in 2020, a larger volume financial institution will be required to collect and report its HMDA data on a quarterly basis. Recall that a larger volume financial institution is one that reported at least 60,000 covered loans and applications, excluding purchased covered loans in the preceding calendar year. For example, a financial institution that reported 59,999 covered loans and applications for their 2019 data will not be required to submit quarterly data in 2020. However, a financial institution that reported 60,000 covered loans and applications for their 2019 data will be required to submit quarterly data in 2020. The first quarter data will be due by May 30th, 2020. Let's move on to the amendments to HMDA made by the Economic Growth, Regulatory Relief, and Consumer Protection Act, which we will refer to as the Act, and the Interpretive and Procedural Rule issued by the Bureau in August 2018, which we will refer to as the 2018 Rule. The Act amended HMDA by adding partial exemptions from some of HMDA's collection and reporting requirements for certain transactions made by certain institutions. Here's how they work. An insured depository institution or insured credit union does not need to collect or report certain data points with respect to closed-end mortgage loans if it originated fewer than 500 closed-end mortgage loans in each of the 2 preceding calendar years. Open-end lines of credit if it originated fewer than 500 open-end lines of credit in each of the 2 preceding calendar years. Note that if your institution has recently received less than satisfactory Community Reinvestment Act exam ratings, then your institution may not be eligible for these partial exemptions. The Bureau issued an interpretive and procedural rule in August 2018 to implement and clarify changes to HMDA made by the Act. The 2018 rule clarified which data points are covered by the partial exemptions. We will discuss each data point in detail in subsequent webinars, but for our purposes today, we've provided a list of the data points that are covered by the partial exemptions. This means that if the transaction qualifies for a partial exemption, then the institution will not need to collect or report the information for that data point. Here is a list of the data points that are covered by the partial exemptions. The 2018 rule also clarified that for the purposes of the partial exemptions, closed-end mortgage loan and open-end line of credit mean only those loans or lines of credit that would otherwise be reportable under HMDA. The 2018 rule designates a non-universal loan identifier that must be reported if a transaction qualifies for a partial exemption and the institution chooses not to report a universal loan identifier for that transaction. We discussed the universal loan identifier in depth in Webinar 2. The 2018 rule clarified that insured depository institutions and insured credit unions that qualify for a partial exemption may report, at their option, exempt data points as long as all data fields that the data point comprises are reported. The 2018 rule also clarifies that for the purposes of determining whether the CRA exemption applies to an insured depository institution that would otherwise qualify for a partial exemption, the CRA examination assessment must be made as of December 31st of the preceding calendar year. Our final topic for today is the policy guidance issued by the Bureau describing the HMDA data it intends to make available to the public. On December 21st, 2018, the Bureau issued policy guidance that applies to HMDA data compiled by financial institutions in or after 2018 and made publicly available by the Bureau beginning in 2019. The Bureau intends to modify certain data fields by binning or excluding to appropriately balance potential risks to applicant and borrower privacy created by disclosure and the benefits of disclosure in light of HMDA's purposes. Otherwise, the Bureau intends to disclose all data as reported by financial institutions without modification. The Bureau intends to exclude the following from the public loan level HMDA data: Universal Loan Identifier or Non-Universal Loan Identifier, Application Date, Action Taken Date, Property Address, Credit Score, Mortgage Loan Originator NMLSR Identifier, Automated Underwriting System Result, and free-form text fields for the following data: ethnicity, race, credit scoring model name and version, denial reason or reasons, automated underwriting system name. On this slide is a chart that shows the data that will be excluded from the public loan level HMDA data. Included in this chart is the Regulation C reference for the applicable data. The Bureau intends to modify the following data prior to making them publicly available: loan amount, age, debt-to-income ratio, property value, total units, multifamily affordable units. The chart on this slide shows the modifications the Bureau intends to make to these data. Lastly, this slide and the next slide show a list of all the data the Bureau intends to make publicly available without modification. We hope you found this webinar helpful. The Bureau has additional resources to help you understand and comply with Regulation C. These are available on the Bureau's website at http://www.consumerfinance.gov/policy-compliance/guidance/implementation-guidance/. Click on the link for the HMDA rule. You can also submit feedback via a link on that webpage. If you have specific regulatory interpretation questions, you may submit them to the Bureau at reginquiries.consumerfinance.gov. Please select Regulation C/HMDA from the pull-down box on the website and provide regulatory cites to indicate the topic of the question. Technical questions about collecting or reporting HMDA data should be directed to HMDAhelp@cfpb.gov. Thank you for joining us in this webinar.